All right. Hello, everyone. Hope everyone's doing well. I know it's been a while since I posted my last video, but I thought I'd give this little lecture on leverage buyouts, or LBOs for short. So I'll just go ahead and get right into it. What is an LBO? So an LBO, or a leverage buyout, is when a financial sponsor, which is just a fancy way for saying a private equity firm, uses a significant amount of debt to buy out a company, typically in hopes of selling the company later on and achieving strong returns. So you can kind of think of it as like house flipping, but with companies. So these private equity firms are basically trying to flip companies. They're trying to buy out companies, make improvements, and then sell them for more than they paid for, getting a return from it, essentially. So there's really two types of entities that are acquiring companies. You have financial sponsors and strategic acquirers. So a strategic acquirer is basically another company. So that's like when Albertsons or when Kroger acquires Albertsons. It's one company acquiring another. That's a strategic acquirer. And then you have financial sponsors, which are like private equity firms. They're not acquiring the company because they want to build a big company. They're acquiring the companies because they hope to flip it later on for a financial gain. So the three main parts of a leverage buyout are really just buying the company, the hold period, and exiting the investment. So buying the company really just entails convincing the owner of the company, whether that's a person, a family, shareholders, to agree to sell it to you. And then also financing the transaction, because a lot of times these transactions require a lot of debt, which has to come from some kind of creditor, and then your equity that you have to put in, which oftentimes you're having to get from your own stakeholders. And then the hold period, this really just entails making improvements to the business and then using the business's cash flows to kind of pay down the debt, because you do have a lot of debt, which is adding risk to you. So it's nice to pay it down using the cash flows that you're generating. And then exiting really just entails selling the company to some other party, whether that's strategic acquirer, another financial sponsor, or maybe even like IPOing the company at the end of the hold period. So I kind of just want to review the effect of debt or leverage on returns. So really the key thing to note here is that leverage and leverage buyouts, or just in general, really amplifies returns. It can make a good investment great and a bad investment a disaster. And typically LBO transactions are financed with 50 to 80% debt, depending on the state of capital markets. So really, they're really financed with a lot of debt. So there's really this amplification of returns. So you kind of illustrate it with this example. Let's say we buy a house for $1 million with 80% debt. So $800,000 of debt, $200,000 of our own equity. If the value of the house goes up to 1.1 million, just up 10% in value, then we earn a 50% return on our equity, right? Because our equity just went from 200,000 when it was 1 million to 300,000 now that it's 1.1 million. So this is great, right? We've made a 50% return. You can see that the leverage is amplifying our returns, given the value of the actual asset only went up 10%. But conversely, this can go the other way. It amplifies it in both directions. If the house were to go down to $900,000, we lose 50% of our money as an equity investor. So you can see here, really, it's going both ways. It's amplifying returns. So this is happening a lot in these leverage buyout transactions. If things go well, it's great. But if things don't go well, it can be really catastrophic for the company you're acquiring. So kind of just the history of LBOs. The LBOs started in the 1980s due to the start of junk bonds, allowing private equity firms to have the financing to acquire companies. Before then, you couldn't really do these risky investments. You couldn't really use debt to acquire companies. Really, the only people that were able to get money from creditors were kind of safe investments, like your HEBs of the world, like really safe companies that were stable. The only really the high yield debt out there was like companies that were safe that became risky. But the junk bond market or high yield market really became prominent in the 1980s. So this allowed LBOs to kind of start to take place, because people could get the financing to acquire these companies, right? Because if a company is worth $5 billion, that's a tall task to get the financing, right? But maybe you can use 90% debt to finance the transaction. So now you only have to put 500 million in. So a lot easier for you. So having this access to, credit markets really allowed people to participate in these private equity leverage buyout transactions. So over time, private equity has become a very popular asset class for like pension funds, sovereign wealth funds, and just really grown. And there's been a lot more capital available to do these leverage buyout transactions over time. It's important to note this is a very like cyclical industry, just because when interest rates are low, like like a year ago, it's much easier to do these kind of transactions because you can use a lot of debt and it isn't that expensive to service the debt. But when interest rates become high, it's much more difficult to get access to the financing, and it's also very costly to raise debt. So very cyclical overall. You'll really see a lot of LBOs when the economy is doing well, and not so many when the economy is doing bad. So this is kind of just private equity illustrated. You can really see here on the left that the financial sponsor is the general partner. The limited partners, which could be like pension funds, insurance companies, just individuals, they're putting money and they're giving it to the financial sponsor to invest on their behalf. So they're kind of limited partner, but the general partner is the one, they're putting in some of their money themselves. They're the one making these investments. So they're the private equity firm in this case. You can really think of like a private equity fund as, instead of a private equity firm investing $5 million into one house and hoping it goes up, they're investing $200,000 into a lot of $1 million houses. So they're just distributing a small check into the equity of a lot of different companies and then hoping that the leverage will amplify the returns, and they're making strong investments. So they're basically splitting up their money into a lot of different houses that they want to flip. So you can really see how this is happening. The private equity firm, obviously, from the name, is putting in the equity in these businesses. Equity is the highest risk but highest reward in these kind of transactions. And then, the equity along with the debt that's you're getting from, the capital markets is going into acquiring this target company. So you need the equity, but also the debt, which they're getting from, some sort of lender out there. So yeah, this is going into acquiring the target company. Private equity firms are doing a lot of kind of these transactions with the capital that they get from the limited partners. So the limited partners give money to the general partners, the private equity firms, to invest on their behalf and acquire these companies, this leverage buyout transactions. So this is kind of this whole ecosystem in private equity. So a big thing is like, what makes a good LBO target? What's really important to note is that leverage buyouts are really inherently risky deals, just due to the large amount of debt, not allowing for a wide margin of error. Like you saw that house example, not a wide margin of error there if the value of the underlying company changes. So as a result, a lot of times these private equity firms are trying to make sure that the underlying asset being bought are typically less risky, because you're applying so much risk by having all of this leverage. So you got to look for things like stable cash flows, a strong management team, a not cyclical industry, because you don't want that to throw off your investment, low capital expenditure requirements, because you want to not have to use your cash for that. And then stable cash flows are also important because you can use that to pay off the debt, right? And then you also want levers to pull, right? You wouldn't want to flip a house that's perfect. You want to flip a house that like there's progress to be done. Maybe you can cut some costs, you could do some add-on acquisitions, you could grow revenue through some sort of strategy. You just want levers to pull so that you can kind of, add value to the company and make even more of a financial gain from these kind of acquisitions. So that's kind of what makes a good leverage buyout target. Just know, typically you want it to be less risky just because of all the risk you're applying using the leverage. So first, we'll just kind of go through entering an LBO investment. So leverage buyouts can be take privates. So that's just taking a publicly traded company private. So you have to convince the shareholders, the board, to let you go through with this acquisition. So for instance, a really famous LBO is like the acquisition of RGR Nabisco by KKR, a prominent private equity firm, in like 1998. So it was very hard for KKR to convince RGR Nabisco to let them go through with this transaction. There was a huge bidding war by other parties that wanted to acquire the company. So with these publicly traded companies, a lot of times there can be contentious bidding wars to see who's going to take the company private, if they want to take it private. But you really have to convince the shareholders to let you do it, right? Most of the time. But a lot of times it's just a privately traded company, which is probably more often than not. You could, your typical kind of maybe like $50 million company that's not going to be public, but you could still, make a meaningful return by flipping that company. So not all of them are public, but a decent amount of times there are. And then either way, the PE firm has to convince the target company to sell the company. And a lot of times, the big thing here is the private equity firm offering the management team an incentive plan to go along with it. You wouldn't want to acquire a company and then the management team just leave immediately, right? You want them to stay incentivized so they can kind of help you out. They have the expertise in the industry. So giving them an incentive plan, like maybe giving them a stake in the equity so that they work hard, is oftentimes, employed by these private equity firms. And then also like the financing for the deal. This is an important aspect. You need to get the bank debt, which is like the lower risk debt that's typically secured by like, the tangible assets of the business. You have the high yield debt, which is the more risky debt, lower down in the capital structure. And then you have the equity, which you're putting in. And then typically the existing debt that the company had pre-LBO is refinanced due to covenants. So there might be existing debt, but it'll typically be replaced by the new debt when you do these kind of acquisitions, when you enter the investments. And then you have the hold period. During the hold period, private equity firms seek to make improvements to the company operationally so they will be able to achieve an attractive return. So the private equity firm can use the cash flows that they generate to pay down the debt as well. This is an important kind of staple of LBOs is if you buy a strong cash flow generating business, then you'll be able to pay down the debt slowly to kind of make this a less risky acquisition for you. Hold periods are typically between 3 to 7 years. What can affect, I used the wrong effects, but what can affect the hold period? Things like, for instance, like maybe a recession might make it where you have to hold a company for longer because there's not as many people that want to sell it. Maybe it didn't go as planned, but just know the ideal hold period is one that's short where you're still making a lot of money because the time value of money, right? You want to make money as soon as possible. So it'd be ideal to hold a company for, less long than, as little as possible, right? But you still want to make a meaningful return and squeeze all the juice out of the company that you can, right? So that's kind of a bit about the hold period. And then how does a private equity firm exit an investment? Really, there's a few different ways. You could sell to another financial sponsor, like another private equity firm. You could sell to a strategic buyer, so like another company. You could go public again. Probably the most preferred way is to sell to a strategic buyer, but it really depends on the situation. But a strategic buyer might be willing to pay synergies. Synergies, basically, they'll pay for synergies. Basically, maybe having this company will really help their operations within their company, so they're willing to pay a premium to you. And then another thing that we should talk about is a dividend recapitalization. And this is another way that a private equity firm can kind of like semi-exit an investment. It's basically when you add debt to your company during the hold period and then use the cash to like pay yourself, the equity holder, a dividend. So you can kind of think of this like, let's say your grandma owns a house and she's really old. She has all the equity in the house, but she needs some money, right? She still wants to live in her house, but she needs some money. So let's say her house is worth $1 million. Maybe she does a dividend recapitalization. Let's say your grandma says, I'm going to take out a mortgage. I'm going to raise $500,000 of debt. So now I'm not going to own my whole house, but I'll be able to use that cash to spend on my own. I can return it to myself and do what I like with it. So private equity firms do this sometimes. They still get to own the company. They can still make more changes, but they get to pay themselves. They get to kind of de-risk some of their equity and return it to yourselves, kind of like your grandma would if she's old and kind of like needs some money. So that's what a dividend recapitalization is. It allows you to kind of partially exit investment because you can kind of return cash to yourself and de-risk your equity overall. So that's a common strategy that's employed by private equity firms. So the primary ways that you kind of measure returns and leverage buyouts. In the LBO, what's really important is equity value. You don't really care about the enterprise value as much, like in a DCF. Enterprise value is obviously important because it's usually tied to equity value. But we really care just how much money did I, as a private equity firm, put into the equity, and what did I end up getting out of it? So what we're looking for is the levered free cash flows in this situation, right? You have unlevered free cash flows, which is basically the cash flows attributable to all the stakeholders in a business, debt and equity holders. It's before the debt holders have been paid, right? Levered free cash flows is after debt holders have been paid, right? So it's basically unlevered free cash flow, but taking into account interest expense and mandatory debt repayments. So levered free cash flows are attributable to only equity holders. Your levered free cash flows, you can really do whatever you want with those as an equity holder. You've already paid your interest and your mandatory debt repayments, so you could return that cash to yourself, reinvest it into the business, etc. Right? And you calculate levered free cash flow very similar to how you calculate unlevered free cash flow, except you just account for interest and then you also account for mandatory debt repayments. So measuring returns, the two main ways that private equity firms measure their returns across an investment are internal rate of return, which is your IRR, which I talked about before, and then your multiple on invested capital, which is your MOIC. And that's basically how much money you made versus how much money you put in. So if you put in $100 of equity and you got $300 of equity out, that would be a 3x MOIC, right? So it's really just measuring the total return you made, where the IRR is more so incorporating like the time value of money into it. And I'll talk about that in a second. Oops, I went back a few slides. But yeah, so kind of continuing this, your IRR obviously simply just the annualized rate of return that the private equity firm achieved from the investment. And then MOIC is just final equity over initial equity. So it's really just showing how much total value was created from the deal. Since IRR definitionally is the discount rate at which NPV is 0, and an NPV of 0 implies a MOIC of 1, final and initial equity being the same, we can kind of derive this equation to kind of compare IRR and MOIC and see how they kind of like translate into each other, if that makes sense. I'll try to break this down. So, right, IRR is simply the discount rate at which NPV is 0. NPV of 0 happens when the present value of all of the cash outflows and inflows equals 0. So if we do an investment, the cash outflow is the initial equity we put in. And that's happening at the very beginning. So an NPV of 0 basically implies that the present value of our final equity amount, the proceeds we're getting, equals the initial equity amount we put in. Because let's say we put in $100, that's a negative 100 cash outflow. So we need the present value of the future cash inflows to equal 100. So we basically discount the final equity amounts by whatever discount rate, IRR, gives us the initial equity value. So you can see here with this first bullet point, final equity divided by 1 plus IRR to T, which is just the amount of years. So you can kind of do some algebra to make this final equity over initial equity equals 1 plus IRR to the T. And final equity over initial equity obviously is just MOIC. So you can see MOIC just equals 1 plus IRR to the T, right? So you can kind of see what this is really meaning, right? Like, let's say I had a 2x MOIC over 5 years. I can just kind of do the math really quickly and be like, okay, 1 plus what to the 5th power equals 2. And it's like, 15%-ish, like 0.15. So that's kind of the relationship between MOIC and IRR. I'll elaborate a bit more on that in a little bit. But strengths and weaknesses of both overall. The strength of IRR is that it accounts for the time value of money, right? Because it's just the whole concept of like net present value. But it doesn't necessarily always account for like the total return, right? Like if you just, made a 1% profit over like 1 month, like that's great, obviously. But like you went through a lot of time and effort just to make a 1% profit. Even if you return the cash to yourself really quickly, it'd probably be better to make a 200% profit over like 6 years, even if the IRR wasn't quite as high. So IRR can be manipulated a little bit by the amount of time. Whereas MOIC, the weakness is like the opposite, basically. It doesn't really account for the time value of money. You might 4x an investment over 100 years, but that's obviously a horrible annualized return. So MOIC isn't really accounting for like the time value of money. So let's just do a paper LBO example. This is like a common interview question. Basically, just kind of seeing if you kind of understand LBOs mechanically, seeing how you think. So let's say that we're a private equity firm and we acquire company A at 10 times EV to EBITDA using debt to EBITDA of 5 times. So In this case, we can kind of just see like, okay, so 10 times EV to EBITDA, debt to EBITDA is 5 times. You know, that basically means that our equity is going to be 50% and our debt's going to be 50%, because our debt right now is 50% of enterprise value, since debt to EBITDA is 5x and EV to EBITDA is 10x. Just know that connection there. Revenue is $100 in year 0 and grows to $150 by year 5. It says assume EBITDA margin stays flat at 20% and the company generates $50 of levered free cash flow throughout the hold period, which is used to pay down the debt at the end of the hold period. Assume we exit at the same multiple as the entry multiple. So let's logic our way through this. The way you always want to start this is, what was the purchase price and what was it funded with, debt or equity or both? So in this case, we bought it 10 times EV to EBITDA. So what is EBITDA? Well, we know revenue is 100 and EBITDA margin is 20%. So that means EBITDA is $20. So 10 times EV to EBITDA means that 10 times 20 is 200. So our total enterprise value, the purchase price, is $200. And if debt to EBITDA is 5 times, that means our total debt was $100, meaning our total equity was $100 as well, just 200 minus 100. So in this case, we bought this company for an enterprise value of $200, 100 of debt, 100 of equity. So now we need to look at like what our total return is, right? So let's see what happened throughout this 5-year hold period. Obviously, revenue grew to 150, and then it says that EBITDA margin stayed flat. So what's our EBITDA going to be in year 5? Looks like it's going to be 150 times 20%, so it's going to be 30. So, and it says we exit at the same multiple as the entry. So we're going to exit 10 times EV to EBITDA as well. So it's going to be 30 times 10. So our total exit enterprise value is going to be $300. So that's just, know that. An important thing is that you use the levered free cash flows generated during the period to pay off your debt. So in this case, we're going to pay off our debt, $50 of it. So we're only going to have $50 of debt at the very end of the hold period. So to get from our final enterprise value of 300 to our equity value, we're just going to subtract our debt, right? That's just the equity and enterprise value equation, right? Equity value equals EV minus debt plus cash. So our EV is 300 minus 100 of debt plus the 50 of cash. So our final equity value is going to be 250. So you can see, kind of using this logic, 250 over 100 is a MOIC of 2.5x. And that's approximately an IRR of 20% because it's a 5-year hold period. You kind of want to memorize these like general MOIC and IRR tables. Usually these questions are 3 or 5 years. Just know like, oh, a 3x MOIC over 5 years is like 25%. 2.5 is 20%. 2x is 15%. It's pretty linear for 5 years. It's easier to remember. And then same thing for the 3-year one. Just kind of remember these. So you can kind of do it off the top of your head. But you can always just kind of use this formula here, the one and the second last bullet point, if you really want to kind of ballpark it using mental math. But, that's just like an overall example. I'll kind of finish off talking about like the risk-adjusted returns of private equity overall. Just remember always that just because the returns from a particular asset class are high doesn't mean that like it's a great investment. Like, leverage buyouts are inherently risky investments, right? You're using a lot of leverage, even if it's a not super risky company. Applying that much leverage just in general makes companies risky. We saw that with the 2008 financial crisis. People assumed the value of houses was never going to go down, so they applied a ton of leverage to houses, the housing market. And once the housing market crashed, it was catastrophic because of all of the leverage and all of the derivatives within this kind of overall market, right? So it's very similar for private equity, right? You have a lot of leverage. So while returns are generally higher than like the S&P, like the average private equity fund probably has like a 20% IRR. The cost of equity is significantly higher for these kinds of investments because of leverage. So like, remember, you always need to you compare your IRR with your discount rate. And in this case, it's IRR, your equity IRR. You should compare that to your cost of equity. But your cost of equity is going to be very high because if you just think of the levered beta equation, you're timesing it by debt to equity, right? Which is very high in these cases. So there's a lot of risk associated with that. So maybe you have a really high IRR, IRR, but that might not be that very good if you have a very high cost of equity. So you just need to always compare your reward with the risk. I just kind of wanted to remind you all of that. But yeah, that's just a quick summary of LBOs in general. I hope you enjoyed it. Yeah, thank you for watching, y'all.